Hello, and welcome to this week's episode of Coinscrum Markets. I'm Nisa. Coming up, Patrick Heusser returns to review the markets this week in crypto RFQ. B2C2's founder, Boonen, joins us to discuss his company's recent strategic funding round. Trustology CEO Alex Batlin speaks to CMT's Brad Koeppen about the recent DeFi explosion. And ByteTree's James Bennett is here to take a deep dive into this week's on-chain data. First, a look at this week's blockchain industry news. 21Shares, the Swiss-listed Bitcoin and Ethereum exchange traded product provider, announced last week that it has changed its digital asset custodian from Kingdom Trust to Coinbase Custody. Horizon Kinetics, the New York-based hedge fund and investment manager with 5.3 billion AUM, has expanded its Bitcoin mining interest by tripling its operations in partnership with US-hosted provider Core Scientific, deploying the latest generation of equipment produced by Chinese manufacturer Bitmain. And Arcane Crypto, the Norwegian firm, has announced its plans for a reverse takeover of NASDAQ-listed Vertical Ventures that, if completed, will see the company traded on the Swedish exchange at $33 million valuation. Swiss bank Incor has partnered with Kraken to provide sterling, Swiss franc, and Canadian dollar deposits and withdrawals starting Q3 of this year. This is another sign that more banks are starting to get comfortable with servicing the industry. Next up, crypto RFQ. Hi, Patrick. Welcome. What's happening with Bitcoin this week?
Hello. And first of all, thanks to have me. And let's start with the price of Bitcoin. We're just, at the moment, we're pushing through the 9,400 level. But if you look at the bigger picture, then you see that we're trying to break this upper leg of this very large triangle. And around 10,500, we're probably going to see some real action in the price, hopefully to the upside, but there will be a fierce fight around that level.
And what's happening with the miners?
Well, good question. We have two very large forces which are determining the price. You got the supply side, the miners, and you got the demand side, which is retailers or institutional clients. But on the mining side, we see a lot of guys being very happy to sell around 10, 11,000. So that 10,500 level seems to be the sweet spot for some pre-mined coins by these guys. And as long as they feel comfortable to sell them out at that level, there is still constant supply coming in. So it's a tough one to break, but if it breaks, the upside is quite open.
So what does Grayscale premium have to do with this as it relates to Bitcoin? Also, for Grayscale Ethereum, why do some people have the premium and others do not?
On the demand side, especially for institutionals or for clients that are not that sophisticated or deep into the market and have no accounts on exchanges or on broker sites, their easiest way is to buy those shares of Grayscale, Bitcoin Trust, or Ether Trust. But those shares are limited. And if people want to get in and they only have fiat to get in, they need to pay a premium. And that premium sometimes, especially in Ether, went totally crazy. And I mean, they paid 18 times more than what they should have paid when they just bought Ether on a normal exchange. But on the other side, you need to be quite careful. Not everyone needs to pay that premium. If you have already Ether or Bitcoin, you can basically pay your share in kind. So I give Grayscale my Bitcoin and I get those shares. And if the premium stays, and after my lockup period, which is usually 6 months on Grayscale, if you buy, you can sell your share again and you lock in that premium, but only if you have already Bitcoins or Ether to pledge. So it's a dangerous game because you don't know how long that premium will stay there. But at the moment, demand seems to be still there, and that premium doesn't really go away. It came off the highs, that's for sure. In Bitcoin especially, I mean, we're trading almost at the very low end of that premium we have seen over time. And on Ether, it is still elevated. So there is still demand, especially on the Ether side.
So do you want to make any predictions about where the movements are going in the next week or so?
I don't really like to make predictions, but currently I feel quite bullish that the market seems to try and push to the upside and is eating into all the supply I see on the screens. So it feels like that the buyers are having the stronger hand right now, but it is tough to make a prediction.
All right. Well, thanks so much for being with us. We look forward to having you back in a few weeks, see what happens. It was back in 2015 when Goldman Sachs swap trader Max Boonen left the banking giant to launch B2C2 to provide market-making OTC services for Bitcoin. With a heavier focus on automation than many of their peers, B2C2 has gone on to become one of the leading liquidity providers in the space. Last week, SBI Financial Services acquired a strategic stake in the company. That will fast-track their expansion. Max joined Teana to reveal what's in the pipeline.
Thanks, Nisa. I'm delighted to be joined today by Max Boonen, CEO at B2C2. Hey, Max, how are you? Thanks for joining us.
Thank you for having me.
Yeah, it's great. So we're here to talk about some exciting news. For viewers who may not be as familiar with B2C2, growing from the two guys in a garage to a team 40 strong across the world, your recent funding round is pretty exciting news. Can you share a little bit more detail with us about where you guys came from and what you hope that this additional funding is going to allow you to do?
Yes. In 2015, we started out purely as an electronic market maker on exchange, providing liquidity on the likes of Coinbase, Bitstamp, Bitfinex at the time. And early on in 2016, we decided that we wanted to make an aggressive entry into the OTC market with a bit of a twist, which is that we wanted it to be electronic. At the time, the incumbents were, basically picking up the phone and doing big trades, and that's the part of our business that's really grown much faster than the rest of the industry. A few things really put us on the map. One, we were first to get into the Japanese market in a big way, and we managed to get all the big brokers in that country to trade with us. Some of the relationships are public, such as with GMO and other very large names. And at the same time, we hired Phil Gillespie, who was running electronic FX for Goldman in London, to run that effort directly in Tokyo. So those things really put us on the map. And in 2019, we hired Rob Catlanello to run our US office. We were one of the latest players to get into the US market. Well, in fact, most incumbents are from the US in OTC trading. We're talking about Circle and others. And that's really only in 2019 that we entered that market and really unlocked a lot of the potential that we were hoping to have there. Now that funding, that deal with SBI, that's taking a $30 million stake in the company, I think that growth story has been quite important in getting them to want to make that transaction. I think that there's two things. First, the non-domestic players in the Japanese market, there's really a handful. So they were quite comfortable with the fact that we had been in their country for quite some time. Yes. And secondly, it's a more classical story of, they like the quality of the offering, especially on the tech side. And there's another thing that's quite important, which is the quality of the client franchise. I don't think that there's anyone in crypto who's got such a valuable institutional client franchise as B2C2.
Yeah, so SBI taking a stake in B2C2, sounds like a pretty big deal. SBI is quickly turning into, a very successful crypto conglomerate, if you will. And I guess that presence in Japan already had, warmed that relationship. What do you see happening from a business perspective from your Japanese market? Do you think that is going to be one of the areas where you're primed to grow?
So one thing that's important to understand about the transaction is that SBI's investment arm has been active in crypto for some time. They have investments in Ripple, R3, Elliptic, and a handful others. But here, it's the business side that is taking the stake. So that's quite different. It's not a venture play. It's the business that is seeing strong synergies with B2C2. And they started getting comfortable doing that because on the 1st of May, the regulations changed in Japan, which I think gave SBI quite a bit of a competitive edge, but one that had to be unlocked by a player like B2C2. There's one big trend within the FX space and brokers in general, which is that more and more of them, in the face of margin compression, are turning into liquidity providers. But that's not something that's easy to achieve. It is not like you can just become a liquidity provider just like that. And I think that having seen B2C2 success in the Japanese market as a liquidity provider, and us being essentially the only regulated player around in specifically what we do, obviously other companies are regulated, exchanges and the like, but as a liquidity provider, it's more or less only B2C2 and perhaps one or two other players. And so all of that taken together, I think made them want to really do that deal.
Yeah, it sounds like there's a mutual benefit for both of you. That's pretty apparent from both sides. So, we know that especially around banking, there's been a long-term, standoff, as it will, between banks and crypto firms, and to some extent, fintech firms as well. With JPM agreeing to a service a couple of U.S. banks recently and exchanges, do you see this as the beginning of the ice beginning to break? And, will a firm like SBI that's already primarily fintech focused be learning things from B2C2 that maybe they haven't done that already themselves?
I think on banking, the ice breaking, I don't want to be too optimistic because it wouldn't be the first time that we think, okay, well, this is happening. I remember actually, I don't really trade myself, but one of my only successful trades of the past couple of years was, I think it was 2014. It was announced that PayPal was going to accept Bitcoin, and the market popped, but it went up 20% and it kind of stayed there. And 20% back in 2014 was a big move, but not crazy big. So I thought, hold on a second, if PayPal is going to be accepting Bitcoin, it should be a much bigger move. So I shorted the market, and from that point, it went lower and lower. Obviously a successful trade. I've had many unsuccessful ones, but I remember that one. So just the fact that JP Morgan is going to be banking some crypto exchanges, I think it's nice. We'll take it. It's good news, obviously, but I don't want that to make us complacent and think that, well, it's okay. We don't need to do any more education and work with the banks to get them to be more comfortable with our industry. Okay. And as to your second question, what is it that SBI cannot do that they need B2C2 to do? I think that's what I mentioned a couple minutes ago. There's this big trend that brokers are turning into liquidity providers. And the reason for that is just the margins are compressing to a level where they have to become liquidity provider and cannot just take prices from others. That's a trend that we see in different countries. In Japan, I think it's quite advanced because the market in Japan with retail FX trading is just much bigger than elsewhere. So basically what B2C2 is bringing to the table is expertise in e-dealing. And that's really key. And actually, interestingly, it doesn't matter the asset class so much. If you can do e-dealing well, whether you do it in crypto, foreign exchange, fixed income, equities, part of the recipe is the same. And one thing that I think we will also see is that SBI is going to move into the prime of prime, the B2B side a little bit more. That's something that we've seen some of their competitors do. It's something that has been done in Europe. A player like IG Markets also serves as a prime broker to smaller brokers, so that cannot directly access the banks for because of credit constraints. And so I think that it's important to them, if they're going to be a prime of prime, they also need to have more expertise in terms of liquidity provision.
Yeah. So, prime services, prime brokerage is, the latest trend, right? Everybody's talking about getting into prime brokerage. And, I've talked to others about why they want to move into the space and providing that bridge between traditional finance into crypto, or the same types of tools that exist in traditional finance into crypto. And so I guess my question to you in that prime brokerage space is, one, is this an opportunity for you? Is that the direction of travel you're moving in? And then two, how would your approach be different to everyone else's?
Yes, it's a good question. As part of the announcement of the deal, we said that we were getting into the prime brokerage market quite actively, and we hope to make a big entry this month. We're rolling out an automated electronic RFQ-based system for funding trades. It's a decision that is matured. Took us a long time to make our decision, because when we get into a new market, we want that to come from a position not of, well, oh no, we need to get new revenues, what are we going to do? We want that to be, we want to make strong commitments. We want to do that with strong intention. And so, it took us a lot of time to get into that market, to make that decision. Just like you don't see B2C2 in the crypto options market, not because we don't think that, it could be a profitable thing to do, but it's just the stars need to align. And I think that now the stars are aligning for a PB offering. What I think everyone's got an interesting angle. As Ari Paul from Block Tower said a few weeks ago, I really like that quote in I think it was in the Block, that a lot of players are trying to address the prime brokerage feature set from different angles, but thus far it's really more aspirational than anything else. And I agree with that. I think that everyone's got an interesting approach, but in each case there's something that's missing. And I think there's three core ingredients to having a successful prime brokerage. I think one, you need proper know-how, and you need to have an electronic offering. It's got to be automated. You can't be doing this in spreadsheets. Just like B2C2's entry into the US market in 2019 with an electronic spot trading offering that was battle tested in Japan with major regulated financial institutions, really changed the competitive landscape in the United States, because people were not ready to compete with such an electronic offering. I think in PB, you need as well to have strong automation to be good with e-dealing. And that's not something that everyone has. The second one is an existing client base, because a lot of people have tried to do a standalone prime broker. And the problem is it relies on such strong network effects that if you just start from a standalone basis, you're going to have to subsidize it to get those clients in a way that is just, it's not sustainable.
Well, and the balance sheet depth, I think, is that critical piece of being able to provide that balance sheet depth. And
so if you start with no clients, you have to charge 5-10 basis points per trade to make it worth your while, to justify the projections to your investors. And today people are just not willing to pay that in crypto, because the spreads have compressed faster than what people anticipated. Our best client, they pay a basis point to trade crypto. So the idea that on top of that basis point, they need to pay 5 basis points for the clearing, for the settlement, it just doesn't work. When we ask them, they say, well, perhaps I'll pay a quarter of a basis point. The problem is that at a quarter of a basis point, you need to attract such monster volumes that it's really difficult to get something successful off the ground if you start with zero. So a player like B2C2, and there's a few others that already have a client base, then that's one of the missing ingredients, and maybe you can build something on top of that. And the third one, as you mentioned, is the balance sheet. Historically speaking, B2C2 has been one of the smaller players because we didn't raise, $200 million from VCs. We really, we're self-funded. It's really our past profits. We've only done a small funding round. So having access to that balance sheet for us has always been a pain point, and we've had to be more efficient, which I think now is turning into a strength. We've got a very strong asset liability management framework, which added to the possible contribution from SBI to B2C2's balance sheet, I think is really going to put us up there with others that have access to very significant amounts of financial firepower.
Okay. Max, it's been so exciting and fun to watch you guys grow over the last couple of years. You have a great team, and you're a stellar guy. So I wish you loads of success. And thank you again so much for joining us today.
Thank you very much, Teana.
Cheers. Back to you, Nisa.
Thanks, Teana. For those familiar with the industry, DeFi has become the hottest topic of 2020, with a multitude of new networks, applications launching, providing new opportunities for yield-hungry traders. For those less familiar, terms such as flash lending and yield farming will seem somewhat alien. To break down some of these new developments, Trustology CEO Alex Batlin spoke to CMT's head of trading, Brad Koeppen, to discuss how his firm is looking at this fascinating yet still experimental space.
Thank you so much, Nisa. I guess let me introduce myself first. I'm Alex Batlin. I'm the founder and CEO of Trustology. Trustology is an institutional custodial wallet provider. We are based out of UK. And we are serving a range of customers from brokers through to funds and token issuers. And I'm really, really excited to be joined by Brad from CMT Digital. Brad, why don't you give us a little introduction to yourself?
Sure. Thanks, Alex. This is Brad Koeppen with CMT Digital. CMT Digital is one of the silos under the broader CMT. CMT is a 23-year-old proprietary trading firm that has traded in the traditional markets from options, equities, futures, and commodities on a global basis. And CMT Digital is sort of the newest group within there. We actually started about 6 years ago when our in-house counsel got interested in Bitcoin, and that interest grew from our lawyer to our partners to eventually launching, making an investment in the space, to launching a trading desk, and then launching a venture capital fund. And then we also do a lot of community building work throughout the ecosystem, including the Chicago DeFi Alliance.
Would you like to give us a little bit of background as to what motivated you guys to start this, and what are the objectives and the key results of the alliance?
Sure. Yeah. So sort of through the years, we started working with Imran Khan, who's based out of Chicago here from Token Daily. And Token Daily is sort of launched the Volt Capital, which is a seed and pre-seed venture fund. Through working with him and his connections, he sort of had the idea like, hey, I'm connected to a lot of these DeFi protocols. They're trying to get connected to some more traditional trading firms as they sort of look to grow in that next phase of their business. And with the trading desk and the venture arm here at CMT, we've always been interested in DeFi. We haven't done any like at scale trading in DeFi, but we've tested a lot of things. We're always trying to learn. So it sort of checked a couple of boxes for us in terms of, hey, we want to know more about DeFi. We sort of know a little bit about a lot of areas of DeFi, but we haven't really taken the time or had the incentive to sort of dig in and learn more about any specific protocol or any one area. So it made sense to us. So the idea was to take sort of the connections from Imran, take CMT, take Jump, take DRW, and a few other people out of Chicago, and sort of try to bridge the gap between DeFi and sort of traditional trading, right? Where a lot of these traditional firms in Chicago have already taken the leap to come into crypto, but they're all trading on centralized exchanges, right? And like you said, we believe in DeFi. We believe that there could be a really big opportunity here to create something very valuable for a lot of users on a global basis. Obviously, like anything crypto, it's still in its infancy, but if the right things are built and the right people are participating, we think this could be a big opportunity. So it was really about allowing us to learn more on the trading side and on the venture side, allowing these DeFi protocols to get to know us and other trading firms, and just sort of broadening the knowledge base there, letting everyone learn from the other side, letting DeFi learn from traditional trading firms, letting the trading firms learn about DeFi. And the amount of outreach that we had was pretty phenomenal. I think we had over 70 applicants for the first cohort. So we took seven DeFi protocols in for the first cohort. We set it up where there were 2 engagements a week, really. Where one was a one-to-many engagement, where we had, I did a roundtable. Someone from Jump Trading did a roundtable. Some like Ernst & Young and a law firm did a roundtable. There was TD Ameritrade and someone from Asari did a roundtable. So we try to set it up so that we can have this broader discussion about DeFi and how these traditional firms are thinking about DeFi. And let the whole cohort sort of interact with each other and interact with the sort of the alliance, the traditional financial firms.
Given what we've seen, the volatility in the markets due to COVID, how do you think decentralized finance weathered the storm, and what does that mean for the future?
I think it weathered the storm pretty well. In any moment of volatility, even traditional markets have issues, as we saw in the same time period, right? In early to mid March, there traditional markets had as many problems as DeFi and crypto markets, right? Robinhood's going down. There were some failures of traditional trading firms, right? So to sort of I like to draw those parallels, is that even traditional finance, which has been around for a lot longer than crypto and DeFi, they have issues during these time periods as well. So it's not that there weren't any issues in crypto. It's just that these are growing pains that happen even in traditional markets still. So I just like to remind everybody that while this is still new technology, it's a new ecosystem, it's still around. We did survive that stress test. There definitely were some headaches there. People definitely lost some money. That happened on the traditional side too. And the problem is that during these moments of volatility, liquidity dries up in any asset class, and the number of users in crypto and the amount of liquidity in crypto and the market cap of crypto is still significantly less than traditional markets. So there aren't as many participants to help sort of absorb or correct for that liquidity crisis that happens in volatility. But the encouraging part is that for the most part, everything survived, and hopefully the ecosystem will continue to grow so that as we see more volatility in the future, we have more of these events during these next cycles. There'll be more participants there so that we'll weather the storm better next time than we did this last time. But yeah, it definitely was interesting, and on the traditional side and the crypto side to be trading and being a participant through those events.
So I guess kind of any particular new challenges that we didn't anticipate in the stress test? Did we see anything? Because I was reading about some of the stuff that was happening with DAI. I mean, it's one of the biggest market caps. Any kind of war stories that are interesting to share?
Yeah, so I think the interesting part there is that a lot of these DeFi protocols, they're standing up a two-sided market, right? So they're focusing on, or they have been sort of more focused on the retail side, right? Where they're trying to provide a service to sort of a more retail user that maybe can't get this service in a traditional finance, or they like the idea of the decentralized version better. But those people always need someone to trade against, right? There needs to be someone on the other side of that liquidity. And in DeFi, there's the AMMs, which are providing the more automated liquidity, like the automated market makers. But then on the traditional side, there's the more like market making firms, right? And I think what you sort of saw is that in these moments of time, there isn't always enough liquidity in the system where prices move farther, faster than people thought or had planned for. And that's the hard part, right? Is if you're looking at these markets on a daily basis in a low volatility or normal volatility period of time, the volume and the liquidity looks like it's significant or it's enough, right? The problem is you never know what's going to happen to that liquidity during, huge events. This wasn't like a 10% move. This was a multiple standard deviation move, right? This is
when you don't sleep. Yeah, this is one of those you don't sleep.
Yeah, exactly. This wasn't a normal day, right? So that's the thing is how do you build these protocols? How do you build liquidity into these systems such that when you have this moment in time where volatility is so high, liquidity is so scarce, how do you build in the right incentives for people to step in those moments to provide better liquidity than, March 12th, right? And I think that's now something that people can focus on. It's like, okay, in normal markets, we have the right incentives to have enough liquidity for us to manage this business and manage the supply and demand from all sides. But what happens in those other moments? How do we design this? What do we change? What can we do to sort of make this a little more foolproof for these moments of volatility, such that it'll perform better next time?
What are the going forward opportunities, in your opinion? Is there's people talk about yield farming. They're talking about flash loans, all those kind of things. Where do you think this is going to go? And what excites you guys?
Well, I mean, obviously, with our participation in the DeFi Alliance, we're very excited about DeFi. The yield farming is definitely interesting. I do think that's a short-lived opportunity where I think you're already seeing the more assets that are being deployed on Compound, the harder it is to continue to get those really high rates of return. So I think there will be sort of a tipping point there where the amount of activity on the platform will sort of balance out that rate of return such that it becomes less interesting for some people. But there's going to be the next Compound where we saw a lot of activity on Balancer. They had a bit of an issue with one of their pools, but all of these new products and all these new products that are yet to go to mainnet, right? So like the interesting part I think for us is just that there's almost a new opportunity every day, right? The hard part is staying on top of with the new stuff that's coming out, being able to analyze the risk, being able to make intelligent decisions in terms of where to deploy assets, and in what degree, sort of sizing the trade, sizing the opportunity and the risk to take advantage of them.
As you've been experimenting with DeFi, what other things to watch out for that you advise others? Is it insurance? Is it institutional custody that can support DeFi? Any things that you would kind of top of your mind right now, practical things that you just need to overcome to get there?
Yeah, I mean, I think the one thing I've been excited to see is how the user experience has improved over time on the DeFi side, where people like to make the comparison between crypto and the internet, where in the early days you probably needed to know how the internet worked to use it. But now everyone uses the internet and they don't know how it works because you don't need to. Where there could be a similar path for DeFi, where in the beginning, even now, you sort of need to know a little bit about how all these things work to understand the risks, understand how to use them, and to use them safely and securely, right? But this focus on the user experience, I think, is going to make it easier to use these things, easier to move assets between protocols. But I think the main thing that I worry about is just understanding the risk, right? Is it's part of that from to take a concept that we talked about on the centralized side was the counterparty risk of a centralized exchange, right? Of putting assets on this exchange. What is the risk that those assets are going to be lost, right? And there's a similar risk on the DeFi side, except that risk is not really with the institution, although sometimes it is, because not the DeFi, the decentralization is a spectrum, right? Some things are much more decentralized than others. Some of these platforms, protocols have enough centralization that someone could impact assets there. But some of it is just, the smart contract risk is where I want, on the centralized side, we want to know who's running the exchange, what kind of customer service they have, what their history is. On the DeFi side, we want to know who's writing these smart contracts. How much can you find about these people? Because you can rely on an audit, but anyone who's auditing the smart contracts, they're a startup. So like they're, this isn't like they have 50 years experience of auditing smart contracts. And they're only spending a few weeks with the smart contract. With the founders and the people that work at the protocol that wrote these things, they spent months or years with these smart contracts. So who's writing them? How do they behave? And just sort of trying to continue to increase your knowledge of the protocol, the platform, or the asset you're actually dealing with, so you can better understand the risk, because that's going to help you potentially increase your return from this activity, or avoid the loss of assets.
I'm going to wrap it up. Thank you so much for taking the time to talk to all of us here, and back to Nisa.
Next up, ByteTree's James Bennett takes a look at this week's on-chain data in On-Chain Reaction. Hey, James, thanks so much for being with us today.
Thanks, Nisa. I'm really pleased to be here.
So you have a really unique model for factors that you look at in analyzing demand for Bitcoin. Tell me more about that.
Yes, sure. So it's based on the concept of the network effect, which basically says that the more activity that takes place on a network, the more valuable that network is. So by measuring the level of activity, or we call it the demand that takes place on the Bitcoin network, we can make a judgment call on whether the network is looking strong and you want to be allocated to Bitcoin, or maybe it's looking weak and you want to be in cash instead.
And what are those factors that go into that determination?
So we've got 4 different metrics that we use at the moment. We look at the fees. Well, I should say that each of these metrics, what's important is that they relate to measuring the network demand in some way. So we've got network fees is one. Fees are important because they indicate how much demand there is for block space. A block can only hold about 3,000 transactions, and a block goes every 10 minutes on Bitcoin. So if there's more than 3,000 transactions that want to go in that 10 minutes, people pay extra to prioritize their transaction. So as fees go up, it tells us that there's more activity taking place on the Bitcoin network. So fees is an important one to track. Another one we look at is the transaction value, which is the actual value of these transactions that take place on the network. So Bitcoin does about 2.4 to 2.8 billion with a B dollars of transaction activity a day. And that tells us how much activity is really taking place. So as that number grows, the network's being used more. And of course, if we're transferring 3 billion instead of 2 billion in dollar terms, but the Bitcoin price is, say, $10,000, then Bitcoins are being demanded more in the sense that more Bitcoin need to be used in order to transfer 3 billion rather than 2 billion. Right, so if I need to then use more Bitcoin to transfer the dollar value I'm trying to use, that puts demand on the actual Bitcoin, and that pushes the price up. So we've got fees and transaction value. A third one is network velocity. Velocity, not dissimilar to transaction value, measures how quickly individual Bitcoins are moving around the Bitcoin network. So there are 18.5 million Bitcoin that have been mined, and a velocity of 600% says that those 18 million Bitcoin move through the network 6 times in a year. Again, the more those Bitcoins are moving, the more demand there is for the network, and that is positive for the price. And the fourth and final indicator we use currently is called MRI, which is miners rolling inventory. So the MRI is a really interesting one. When miners generate new coins, they go into their inventory. So they mine it to a wallet, and then they decide, do I want to sell this or do I want to hold on to it and sell it later? And that decision can be driven by a number of different factors. But from our point of view, what we think drives the miners selling is strong price in the market. So looking at this MRI, which is the difference between how much they're selling and how much they're generating, we see that when the price is strong and the market can take it, then miners are selling big amounts of inventory. But when the market is looking weak, actually miners hold back. Funnily enough, people think that miners just are continuously liquidating their inventory as they produce it, but on chain, we see that that's just not the case. So there you go, 4 key indicators you can look at for tracking network demand.
Fantastic. And so what are you seeing on a relative basis right now for Bitcoin's price movements? Any predictions?
Yeah, that's a great question. This year's been really fascinating. In the run up to this, pre COVID-19, what we saw was that network demand was actually dropping. So price had been steadily rising, but network demand just wasn't keeping up with that rise in price. So we had a big drop in price around that time, partly because of that COVID-19, but also the natural network effect dropping. Once price fell, there was a flurry of activity. People got really excited about the lower Bitcoin price, and there was a surge in activity. And we've seen then network demand rising steadily since March up until June. And of course, Bitcoin has rebounded significantly since then. That run lasted until about the 11th of June. Now, at the 11th of June, we started to see a drop-off in network activity again. And so our models basically told us, whoa, the market's getting a bit carried away on price. Right now is a good time to hedge into cash. And so we hedged into cash at the model did at $9,800. The price actually followed the network again and pulled back to about 9,000, at which point activity picked up again. Velocity is on the rise. We've seen fees and transaction activity all picking up the last week and a half, which is a really good signal for price increasing. And right now, as of today, I can tell you that we're pretty bullish. We're seeing 4 out of our 6 indicators are currently on, which means that we are allocating to Bitcoin at the moment.
Any other factors like potentially too many exchanges out there or altcoins, some of the other things you're seeing in the news factor into your analysis?
So right now, they're not. I mean, we keep it really simple. It's a vanilla approach. There are so many fascinating data points now coming out of this industry from, like you say, exchange traded volumes, OTC volumes, sentiment data, like stuff on Google search trends and such that you can incorporate into these amazing models. But, with the complexity, you can often lose some of the sort of impetus that the model has. So we've tried to keep it really simple. It's the network effect that drives our philosophy. And what I can say, Nisa, is that at the moment, we're only looking at Bitcoin. And Bitcoin has utility. If you look at being able to do intercompany or intercountry, settlements. If you look at the sort of trading activity that takes place, if you look at businesses, some businesses taking crypto payments, the Lightning Network, small but growing, it has utility, and that's very exciting. But when we look outside of Bitcoin, something like Ethereum, I mean, we're so eager to get our models applied to Ethereum because I just see so much real utility in that ecosystem at the moment.
Absolutely. Well, thanks so much for being with us today. We look forward to tracking and having you back in a few weeks and see how this played out.
Thank you so much, Nisa. Have a great day.
Thanks, James. You've been watching Coinscrum Markets. See you again next week.